Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Matt Heinz, Senior Managing Director at Aon Transaction Solutions, with an update on global M&A activity. Matt, it's great to have you with us. Welcome to Trade Talks.
Thanks so much for having me. It's a pleasure.
And Matt, in the fourth quarter of 2019, M&A sentiment was high, coupled with fear of coming back down to earth, just like any other valuation. Did anyone anticipate the level of impact COVID-19 lockdowns brought to the M&A space?
I don't think anyone could have anticipated the slowdown that we ultimately saw. I've been in the industry for a little bit over a decade. And so in the Great Recession in 2008, 2009, we obviously saw something similar where, just the financial system was broken, right? And debt markets were completely out of whack. This was completely different in that we just saw businesses themselves seizing for no other reason than folks were told to stay home and they just were not permitted to continue with their ordinary course business. I don't think anybody could have foreseen the depth of the slowdown that we ultimately endured, or frankly, the speed at which the M&A market has started to rebound. I mean, I know that's something we'll talk about in a moment, but it has been much more rapid than I think folks suspected. Given the valuation challenges that you mentioned before. I mean, it was just very hard for any buyer, whether private equity or corporate, to value a business when that business is not doing business.
And Matt, and I think that's so interesting, the V recovery shape that we've seen in the markets, also with M&A, we're even seeing it in the IPO market as well. Has the recovery surpassed your expectations? And what are your expectations for the fourth quarter and first half of 2021?
Yeah, I would say that it has surpassed expectations so far because I think folks have just generally gotten more comfortable, again, valuing businesses in the midst of a pandemic. You think about a private equity fund valuing a business off LTM EBITDA. If you've got a whole quarter of missing or depressed EBITDA as a result of a shutdown, how do you account for that? How do you account for that, and how do you adjust for that when coming up with a cogent valuation on go forward business and success and growth? As in terms of Q4 and first half of 2021, which can't arrive soon enough, frankly, I think we're optimistic. But as with all things, I think the virus will decide a lot of this. If we do endure another prolonged and significant lockdown at any point over the next 6 months, I think that will have a similar effect, with the caveat that I think folks have adjusted their approach to valuation and their approach to a business that's in the midst of a cataclysmic event like this, to come up with a more cogent and accurate assessment of valuation go forward. I think people have adjusted their way of thinking around this by necessity in order to get more comfortable with an acquisition, even in the context of a slowdown as we've seen.
Which industries performed well during the pandemic?
Yeah, I mean, I think it's common sense. You'd say that businesses that focused on essential industries obviously were not only not harmed, but actually performed better. And so we saw a lot of activity around those. Any sort of business that was asset heavy as opposed to people heavy, so infrastructure still did quite well. Some internet-based service businesses, so whether internet, e-commerce or other online learning services that didn't involve interpersonal activity or folks showing up at the office, still did quite well. And we saw robust activity, in those sectors, even during the midst of the heaviest portions of the lockdown. On the flip side, again, common sense, I think, dictated that we saw businesses with exposure to international supply chains that had been shut down were particularly hit hard. Businesses where, again, interpersonal contact or some personal level of service was involved was hit hard. An interesting sector was healthcare. I think at the beginning of the lockdown, we saw healthcare really slow down a bit because there was just so much uncertainty, and the overwhelming of the system led to folks just kind of backing off and taking a step back. I think healthcare industry investors now are thinking about what the world will look like post-pandemic and actually seeing pockets of pretty intense activity and attractive assets go forward, because again, they're thinking about what the world will look like 18 months from now on the back end, hopefully, of the pandemic, and what folks will be buying and what services they'll be seeking at that time.
And Matt, for the benefit of the audience, what kind of activity takes place with the segment, with the industries, or do they simply go away? Is there some restructuring that takes place? What happens in the M&A world to hopefully bring some of these businesses back online?
For me, it all, again, boils back down to valuation. I mean, I think if you have an investor who's able to make an educated guess on the performance of a business over the coming, it depends on time horizon, right? Corporates have a different time horizon and view of what success looks like than private equity funds do. But if you can get a handle on the normal run rate of a business, even despite the headwinds that a global pandemic provide, I think folks would be willing to take a bet on those. And again, as with any other, dislocation, perhaps even seek some sort of arbitrage or ability to capture an asset at a depressed rate or a depressed valuation, given everybody else's caution.
And Matt, to wrap up here, and we've said this earlier in the interview, that many of us are looking forward to 2020 coming to an end, but there were some unintended benefits as a result of the COVID-19 lockdowns. Tell us about that.
Yeah, so I've referenced it before, but I was at AIG back in 2008, 2009 on the underwriting side. And so at that time, at that place, I quickly became acquainted with the concept of turmoil breeds opportunity, right? There's plenty of turmoil and there's plenty of opportunity then. We've seen the same thing in our market over the last 6 to 8 months. Some of the deal structures that have changed have been a lot more focused on earnouts and on deferred consideration. When the stock market crashed and equity values were so depressed, we saw a ton of interest from private equity funds in particular in the PIPE market. So we started investigating, how can the product that we sell, rep and warranty insurance, primarily, how can that be applicable to a PIPE investment? Is there a risk transfer there where our insurance can make things a bit more efficient and a bit more palatable? Obviously, distress deals are going to be, have started to percolate, more heavily, and will continue, to be a main source of activity going forward. We're doing a lot more in the distress space and trying to figure out ways to address or adjust our business to address the concerns in a distress deal. So look, turmoil in this case didn't breed turmoil didn't breed opportunity, it bred innovation. And so we've thought about a bunch of different risks and how to approach them in a new way. And I think that's going to yield benefits and help our clients, frankly, going forward once we're on the other side of this.
All right, Matt, appreciate the insight. Thanks for joining me on Trade Talks.
Thank you so much.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.